Welcome to the Deep Dive.
Hey there.
Today, we are really getting into one of the most, foundational companies in finance, but one that's often kind of opaque, Equifax. Ticker EFX on the NYSE.
Yeah, everyone's heard the name, probably not always for the best reasons, but few grasp the sheer scale, I think.
Exactly. So our mission today is to go beyond those headlines. We're digging into some really detailed source material excerpts from an Equifax investment memo analysis.
Okay.
We want to uncover its business, its strengths, which are considerable, its vulnerabilities, which are maybe surprising, and its financial picture.
Right.
The goal really is for you listening to walk away feeling genuinely well-informed about this critical, but yeah, definitely controversial company.
Sounds like a plan. Where should we start? The core business.
Let's do it. Jump right in. What exactly is Equifax at its heart?
Well, it's interesting. They position themselves as a global data analytics and technology company. I mean, they operate in 24 countries.
Wow, 24.
Yeah. Think of it like a piece of critical infrastructure almost, the basic model. It's actually pretty straightforward. They collect, aggregate, and analyze just massive, often unique data sets.
On consumers and businesses, right?
Exactly. And then they sell access to that data, or more often, the insights derived from it.
To who, mainly?
Oh, all sorts. Financial institutions are huge customers, obviously, but also big corporations, government agencies, employers, anyone who needs to verify identity, creditworthiness, or employment.
And these massive data sets, they translate into serious revenue. The analysis mentioned $5.7 billion in 2024.
That's right, $5.7 billion. And that was up 8% from the previous year, which is pretty solid growth.
Okay, so how does that break down? It's not just one monolithic thing, is it? There are segments.
Correct. Three main segments, and understanding these is key, I think. First, the biggest, fastest growing, and highest margin one, Workforce Solutions, EWS.
Okay.
EWS.
Yep.
That's 43% of their 2024 revenue. Its crown jewel is the Work Number, or TWN.
I've heard of that. What does it do exactly?
It provides instant digital verification of someone's income and employment history. It's not just a product. It's like woven into the fabric of lending and background checks now.
Instant verification. That sounds powerful.
It is. And here's the kicker. It's largely recession-proof. Even countercyclical.
Countercyclical. How does that work?
Think about it. When the economy slows down, what happens? More people apply for unemployment, food assistance, housing benefits.
Ah, I see. And government agencies need to verify past employment and income for those benefits.
Exactly. So demand for TWN actually increases during downturns. Its non-mortgage revenue grew a strong 8% in 2024, even with economic headwinds. It's a fantastic buffer for them.
That's a really powerful dynamic. Okay, so EWS is the biggest chunk. What's next?
Next up is U.S. Information Solutions, USIS, about 33% of revenue. This is the part most people think of as Equifax, the traditional U.S. credit bureau.
So credit reports, credit scores, that kind of thing.
Yep. Consumer credit info, commercial credit info, scores, but also technology for decisioning, identity management, fraud prevention tools. They make money from transactional fees every time someone fills a file, and also subscriptions.
Got it. And the third piece?
That's international. Makes up the remaining 24%. It basically mirrors what USIS does, but, outside the U.S. and 23 other countries.
And that's not insignificant either.
Not at all. It crossed $1 billion in revenue for the fourth year running in 2024. And grew nearly 19% on a constant currency basis. So strong growth there, too.
So when you piece it all together, despite all the data complexity, the core business model, it feels, remarkably simple in a way.
It really does. Someone described it perfectly in the analysis. It's like an essential toll road.
A toll road. I like that.
Yeah. Equifax controls these unique mission-critical data sets, and they charge a toll for anyone who needs access, which, in a credit-based economy or for employment verification, is almost everyone.
It's an information intermediary basically baked into the system.
Absolutely.
Yeah.
And its endurance seems highly likely. Why? Well, structural economic needs. The U.S. alone has consumer debt nearing, $17 trillion? Assessing creditworthiness isn't going away.
Never.
And verifying income and employment for jobs, benefits, loans, that's also permanent. Plus, the fundamental human and commercial desire to mitigate risk and prevent fraud. That's evergreen.
That desire isn't going anywhere. So the business is really resilient.
It is. While the USIS part can be cyclical, tied to things like the mortgage market.
Right, mortgages go up and down.
EWS, with that non-cyclical and counter-cyclical demand, provides a huge buffer. It makes their overall earnings stream much more durable than, say, a pure credit bureau.
Okay, that makes sense.
Well,
Let's talk about the competitive fortress then, the moat. The analysis mentioned a formidable dual economic moat.
yeah, and it's a good way to put it. Two main components, intangible assets and network effects.
Intangible assets meaning the data itself.
Exactly. We're talking 125 years of history collecting unique, hard-to-replicate data, especially proprietary data sets like the work number. That's not stuff you can just scrape off the internet. It's deep, historical, and often exclusive.
Okay, so the unique data is one part. What about network effects?
This is maybe even more powerful. It operates on a give-to-get framework.
Give to get.
Yeah. Thousands of lenders, utilities, employers, and others contribute their own proprietary data into the Equifax system. Why? Because in return, they get access to the aggregated data from everyone else.
Ah, I see. So the more data contributors they have?
The more valuable the aggregated data set becomes for everyone, which attracts even more contributors. It's a virtuous cycle.
And that creates a massive barrier to entry for anyone new.
Almost insurmountable. Imagine trying to start a competitor. You have no data to offer back. Who's going to give you their valuable data? Nobody. The network can't even form. It locks in the existing players. Equifax, Experian, TransUnion, this oligopoly.
Can you give a concrete example of this moat in action, like with the work number?
Sure. Imagine you're a lender looking at a mortgage application. The standard credit report from, say, USIS might give you some history.
Okay.
But then, using the work number, you can instantly verify the applicant's detailed income and employment history digitally right now. This isn't available anywhere else on this scale. It's an only Equifax capability.
Only Equifax.
So the lender can make a much faster, much more confident decision. They might approve a loan they otherwise wouldn't have, or catch fraud they might have missed. It streamlines everything.
And that demonstrates how TWN generates those high margins and strengthens the whole ecosystem, keeping competitors out.
Exactly. It's the moat working perfectly.
Now, the analysis also stressed that this moat isn't static, it's actively widening.
That's a crucial point.
Yeah.
Management isn't just sitting on this advantage, they're aggressively reinforcing it.
Yeah.
Deliberately.
How are they doing that?
Several ways. One is proprietary data expansion. They're constantly adding more records to the work number. It grew 12% in active records just in 2024.
12%! That's huge growth on an already massive base.
It is. Reaching 188 million active records, covering nearly 233 million unique individuals. And they have strategic partnerships, like with Workday, feeding even more data in.
Okay, so more unique data. What else?
Technological fortification. This is where that huge cloud investment comes in, roughly $3 billion.
$3 billion. That's serious money.
It's transformative. They migrated from over 100 fragmented old legacy systems onto a single unified data fabric in the Equifax cloud.
And the benefit of that is?
Speed.
Yeah.
Innovation, security. It allows them to leverage AI, what they call EFX.AI, across all that data, build more predictive models, launch new products way faster, and it creates a big technological hurdle for anyone trying to replicate what they do.
Data barrier and tech barrier, got it. And acquisitions.
Oh, yeah. Strategic acquisitions. They've spent nearly $4 billion on 14 bolt-on deals since just 2021.
14 deals, like what?
Very targeted ones. Teletrack, which focuses on data for the underbanked population. Count and Mitigator, boosting their fraud and identity capabilities. Appriss Insights and Logics, strengthening workforce solutions even further. And a big one, Boa Vista Serviços, giving them a major footprint in Brazil.
So each deal adds another layer, another capability, making that fortress even tougher to breach.
Precisely. It's a multi-pronged strategy to continuously widen that moat.
Okay, this all sounds incredibly strong from a business perspective, but now let's get into the scuttlebutt. The customer and employee view. The analysis paints a picture of, well, two very different customer experiences.
Yeah, this is where it gets complicated. Let's start with the business customers, the ones actually paying the bills.
The lenders, the employers.
Right. By all accounts, they are incredibly sticky.
Sticky meaning?
Meaning they don't leave. Equifax services are deeply integrated into their workflows. Switching costs are high. The services are often indispensable. You see it in the consistent revenue growth, their ability to push through price increases. Businesses might grumble, but they rely heavily on Equifax.
Okay, so the paying customers are locked in, but then you have the consumers, the people whose data is the product.
And their sentiment is, well, it's the polar opposite. Overwhelmingly negative is probably an understatement.
Really? What's the evidence for that?
Look at their Better Business Bureau profile. The analysis cited, what was it, 6,862 complaints in just 3 years.
Wow, nearly 7,000 complaints. About what?
Mostly the same things. Inaccurate information on the reports, finding it incredibly difficult or impossible to get errors corrected, and dealing with the fallout from identity theft.
And that's surely tied to the big incidents, right? The 2017 data breach.
Absolutely. That breach exposed data on 147 million Americans. It was catastrophic reputationally. And then more recently, in 2022, there was a coding error that gave millions of people incorrect credit scores for weeks.
Ouch. That doesn't help build trust.
Not at all. And even though the BBB gives them a B rating overall, which is kind of surprising given the volume.
Yeah, how does that work?
It considers how they respond, I guess.
Yeah.
But the sheer number of complaints points to a deep well of consumer frustration and anger.
And the core issue is this power imbalance, isn't it? As a consumer, you can't just say, no thanks, I don't want Equifax to have my data.
Pretty much. If you want to participate in the modern economy, get a loan, rent an apartment, sometimes even get a job, you are effectively their product, whether you like it or not. You can't opt out easily, if at all. And that fuels this public animosity.
Okay, so businesses locked in, consumers furious. What about the people inside? The employees?
Also seems pretty mixed, based on the analysis. There's definitely positive sentiment. Some employees, especially in tech roles, praise the investment in the cloud platform, the cutting-edge work. They mentioned flexible work options, good benefits like a strong 6% 401k match.
And didn't they get some recognition?
Yeah, they landed on Time Magazine's list of America's best mid-sized companies.
Sure.
So clearly they're doing some things right internally.
There's always a but.
But there's also a darker narrative, as the analysis put it. Complaints about poor middle management, bureaucracy, and something a bit unsettling.
Go on.
Reports of a big brother culture, suggesting the company uses its own products, maybe even the work number, to monitor its own workforce.
Wow. Using their own tools on their own people, that's something.
Yeah, so a real mix internally as well.
This intense consumer anger, this distrust, it feels like more than just bad PR. The analysis framed it as a potential long-term vulnerability, like the fortress is built on shaky ground.
I think that's exactly the argument. This isn't just noise or a few disgruntled people. It's a latent structural risk.
How so?
Because future flashpoints are almost inevitable. Another big data breach, maybe a scandal over how data is used or sold.
Right, given the amount of data they hold.
It could trigger a fundamental shift. Imagine lawmakers finally responding to years of public anger by passing sweeping data privacy legislation in the U.S.
Like GDPR in Europe.
Exactly. Things like a Consumer Data Bill of Rights, right to be forgotten, rules forcing data portability, allowing consumers to easily take their data elsewhere.
That could really hit Equifax's core advantage, couldn't it? Their exclusive control over certain data.
It could fundamentally undermine their data exclusivity.
Yeah.
And by extension, their economic moat. So yeah, that consumer animosity, it's a critical long-term vulnerability simmering beneath the surface.
Okay, that's a sobering perspective. Let's shift to the people running the show. Management, stewardship, and financial resilience. Mark Begor came in as CEO right after the breach.
Yeah, April 2018. He basically inherited a company in absolute crisis mode after the 2017 breach. His stated mission from day one was building the new Equifax.
And his philosophy seems very focused on the long game.
Definitely. The analysis portrays him as having a long-term, owner-oriented perspective. He's the architect behind leveraging that huge cloud investment for growth, pushing for those only Equifax solutions we talked about, driving new product revenue. They have a metric called the Vitality Index for that, and focusing on expanding margins.
And the board seems to back him.
Apparently so. They extended his contract beyond 2025, which signals confidence in his leadership and the direction he's taking the company.
What about how they've used the company's money, capital allocation? The analysis laid out a very deliberate three-phase approach.
Yeah, it's quite clear when you look back. Phase one, roughly 2018 to 2024, was all about reinvestment and fortification.
Fixing things and building muscle.
Exactly. You had the massive internal reinvestment, that $3 billion in the Equifax cloud, driven initially by security remediation post-breach, but also building the platform for future innovation.
And at the same time, they were buying companies.
Yes. Concurrently, nearly $4 billion deployed on those 14 strategic bolt-on acquisitions since 2021. Appriss, LawLogix, Count, Mitigator, Boa Vista in Brazil, all designed to add unique data or capabilities, widening the moat.
Okay, so reinvest, acquire. Then phase two.
Phase two was deleveraging and consolidation, mainly in 2023 and 2024. After making that big Boa Vista acquisition, management basically hit pause on major M&A.
Smart move to digest.
Very prudent. Focus on integrating the new companies and, crucially, paying down debt that they'd taken on.
And were they successful in deleveraging?
They were. By the end of 2024, they got their leverage ratio, net debt to EBITDA, back down to around 2.6x. That's comfortably within their target range of 2.5x to 3.0x.
Shows discipline.
So they fixed the tech, bought some companies, paid down the debt, which leads to phase 3.
Phase 3. Harvesting and shareholder returns. This really kicked off or was announced in early 2025.
What does that look like?
A clear pivot. They announced a significant 28% increase in the quarterly dividend and launched a new multi-year $3 billion share repurchase program. So shifting from heavy investment to returning more cash to shareholders.
Exactly. When you look at that sequence, reinvest, fortify, deleverage, then return capital, it seems highly rational, disciplined, aligned with creating long-term shareholder value.
Okay, it sounds like a well-executed financial strategy. Let's look at the financial fortress itself, qualitatively. Is this a profitable company?
Oh, absolutely. Despite headwinds, revenue grew consistently from $3.4 billion back in 2018 to that $5.7 billion in 2024. It's a reliable, high-margin machine.
There was that net loss in 2019, though.
Right. But as the analysis pointed out, that was an anomaly. It was due to the massive legal settlements from the 2017 breach, not a reflection of poor underlying business performance.
Gotcha. And the margins?
Very strong. The business has powerful operating leverage. Workforce Solutions, EWS, boasts adjusted EBITDA margins over 50%. That's incredible.
Over 50%. Wow.
Yeah. And the overall company consistently operates in the low to mid 30% adjusted EBITDA margin range. Very healthy for this type of business.
What about some key quality ratios? Return on invested capital, ROIC. The analysis suggested the historical numbers might be misleading.
Yeah, a bit. Historically, it's been around 7-11%, but that number is artificially suppressed.
How so?
Well, firstly, by all the goodwill sitting on the balance sheet from those acquisitions. That inflates the invested capital part of the calculation. Secondly, ROIC was held down during the peak investment phase of the cloud transformation high CapEx. Profits not yet fully reflecting the benefits.
So the expectation is that ROIC should improve significantly now.
That's the strong implication. As CapEx declines post-cloud build-out and as they leverage the new platform to drive more profitable growth, no pad, ROIC should see a significant positive inflection. The market might be underappreciating that potential uplift.
Okay, so ROIC might be better than it looks. What about free cash flow?
Now that is a clear strength, and it's inflecting powerfully. In 2024, they generated $813 million in free cash flow. That was a 58% jump from 2023.
58% increase.
Yeah. And it represented an 89% cash conversion ratio, meaning 89% of their adjusted net income turned into actual free cash flow.
That's very strong conversion.
It is. And management guided for nearly $900 million in FCF for 2025, getting closer to their long-term target of 95% plus stay. It really highlights how cash generative the business is, especially now that the heavy lifting on the cloud investment is done.
And the balance sheet. Debt levels.
Looks solid. As we mentioned, net debt to EBITDA was around 2.6x at the end of 2024, right in their target comfort zone. That prudence gives them flexibility and a margin of safety.
So summing up the financials from, say, 2020 to 2024, consistent revenue growth, stable high margins, reliable earnings, strong FCF inflection, improving conversion, disciplined debt management, it paints a pretty healthy picture.
It really does. Financially, they appear to be in very good shape, executing that turnaround plan well.
Which brings us to the million-dollar question, or maybe the $32 billion question. Price versus value. The analysis concluded the stock price is demanding.
That was the clear takeaway, a demanding entry point. Let's look at the numbers. The trailing PE ratio looks really high, like 50-55x, but that's distorted by some non-recurring items from the past.
Okay, so trailing PE isn't that useful here. What about forward PE?
Looking forward, based on 2025 consensus EPS estimates around $7.61, and assuming a share price around $260, you get a forward PE of roughly 34x.
34 times forward earnings, is that high?
Historically, yes. It's significantly higher than the general market average and also above Equifax's own typical historical valuation range.
What about on a cash flow basis? Price to free cash flow?
Also quite demanding. With a market cap around $32 billion and that 2025 FCF guidance near $900 million, you're looking at a PFCF ratio of about 35.5x.
Okay, so 34x forward earnings, 35.5x forward free cash flow.
Right. The conclusion from the analysis is pretty stark. The market seems to be fully pricing in continued strong execution, robust growth, margin expansion, great FCF generation, all the good stuff.
Leaving minimal margin of safety for investors at current prices.
Exactly. The price seems to assume everything goes right.
So if the market's already priced for perfection, what's supposed to drive growth from here? Where does the upside come from?
The analysis points squarely at new product innovation, NPI, as the most critical growth engine going forward.
Using that new cloud platform and all that unique data.
Precisely. Especially leveraging the work number. The goal is to move beyond just selling commoditized data points towards selling higher value, higher margin analytical solutions.
Like what kind of solutions?
Think new types of credit scores that blend traditional data with income and employment data from TWN. Or developing specific tools to help lenders evaluate consumers who might currently be considered unscorable using traditional methods. It's about creating unique insights no one else can offer.
Moving up the value chain, essentially.
That's the idea. They have this internal metric, the Vitality Index, tracking revenue from products launched in the last 3 years.
Right, you mentioned that earlier. How are they doing on that?
Pretty well, apparently. They exceeded their goal of 10%, hitting 12% in 2024. That translated to about $650 million in revenue just from new products. That innovation is absolutely key to justify the valuation and deliver on the growth promises.
Okay, NPI is the engine. But let's not forget the risks. We touched on them, but what are the big ones that could cause permanent impairment?
Number one, without a doubt, remains a catastrophic data breach and subsequent reputational collapse.
Still the biggest bogeyman.
It has to be. The 2017 breach was almost a near-death experience for the company, $1.4 billion in settlements, lasting damage. They've spent billions on security since then, but they are still target A for sophisticated hackers. A future breach on that scale, or worse, it could be fatal.
Okay, breach risk is number one. What else?
Adverse regulatory and legislative change. We talked about this. They're constantly under scrutiny from the CFPB, the FTC, politicians. That deep consumer animosity creates very fertile ground for regulatory action.
And a major shift, like a U.S. version of GDPR.
Could fundamentally alter their ability to exclusively control and monetize data, striking at the heart of their moat. It's a perpetual risk hanging over them.
Any others?
Well, longer term, there's always the risk of technological disruption and data obsolescence.
Meaning new ways of doing things could make their traditional data less valuable?
Potentially. Think about decentralized identity using blockchain or fintech companies developing models based on real-time cash flow analysis instead of historical credit reports. These are longer-term threats, but things that could eventually erode the value of Equifax's core assets.
Okay. Risks noted. Now let's pull back for some second-level thinking. We've laid out the business, the moat, the financials, the risks. What's the general market consensus view on Equifax right now?
Based on the analysis, the market narrative is overwhelmingly bullish, really positive.
What's the story the bulls are telling?
It's basically successful turnaround post-breach, check. Massive cloud transformation complete and ready to leverage, check. Business now at an inflection point for accelerating growth, expanding margins, and gushing free cash flow, check.
So the new Equifax story has been fully embraced.
It seems so. Analyst ratings are predominantly strong buy or buy. Price targets suggest significant upside. The market appears convinced that the problems are in the past and the future is bright.
Okay, that's the consensus. But the analysis we're drawing from offered a significant contrarian view, didn't it?
It did. A sharp divergence from that bullish consensus. The core argument is that the market is dangerously underestimating the fragility of Equifax's social license to operate.
Explain that. The market sees the consumer complaints, the past glitches, the anger as just noise, background static.
Essentially, yes. The market focuses on the tangible financial outputs, the revenue, the margins, the FCF, the new products, which admittedly look good. But this analysis argues the market is ignoring the fundamental input, the data, and, crucially, the social permission required to aggregate and monetize that data, especially data consumers don't provide willingly and struggle to control or correct.
So the idea is that this amazing fortress, this moat, is built on a foundation of consumer distrust and political toxicity.
Exactly. That's the societal fault line. The analysis argues the moat, while financially and technologically strong right now, is inherently brittle because of this social and political dimension.
And the risk isn't a slow decline, but a sudden break.
Precisely. A sudden, sharp, and catastrophic fracture. Think about it this way. A kind of red team challenge scenario was posed.
Okay.
If the bull case actually plays out perfectly, if Equifax becomes even more successful, even more deeply embedded, uses AI to create even more comprehensive profiles.
Success makes it a bigger problem.
A bigger target for hackers, definitely. But also more alarming to the public and politicians. Its immense power becomes undeniable and potentially threatening.
So if another massive breach happens in that context,
it wouldn't just be 2017 again. It would likely be perceived as an order of magnitude worse. The public and political backlash would be immense, potentially uncontrollable.
And the regulatory response could be draconian.
Absolutely. Years of simmering anger could boil over. Lawmakers might feel compelled to act decisively, passing the kind of sweeping legislation we discussed. Forced data portability, a real right to be forgotten. Strict liabilities for data accuracy, things that could fundamentally break Equifax's exclusive data control.
Legislating away their moat, essentially.
That's the risk. Permanently breaking the high-margin business model that the current valuation relies upon.
So the final judgment, the contrarian take, is
that investors today might be paying a premium valuation, pricing in all the positives, for a fortress that, while impressive, is built upon a societal and political fault line that the market is choosing to ignore.
Wow. That's a powerful counterpoint to the bullish narrative. A fortress on a fault line.
It definitely gives you pause. It highlights a risk that doesn't show up neatly on a balance sheet, but could be profound.
Okay. So let's leave our listeners with a final thought to chew on, building on all this.
Sounds good.
Given Equifax's undeniable importance to how our economy functions, yet its deep reliance on data that individuals often provide involuntarily and struggle to control, that core tension.
How might that balance of power between huge data aggregators like Equifax and individual citizens, how might that evolve over the next decade? And if it does shift, what could that really mean for companies like Equifax?